In this video, I'm going to go over the 4 key factors that unlocks the mortgage, whether you're refinancing your home or looking to apply for a home loan so you can buy the property of your dreams, right? Those 4 factors are as follows. This applies to all mortgage transactions, right? Number 1 is your identity. Number 2 is your credit. Number 3 is your income. And number 4 is your debt to income ratio. These 4 factors will dictate whether you're going to qualify for a mortgage refinance or even to buy a home, right? You qualify for a purchase loan to purchase that house that you want of your dreams. So those 4 factors are important in every transaction of the mortgage world. And I'm going to go over these with you in detail and what it is and how you could use it to your advantage, so that way you know when you're applying for a refinance or applying to purchase a home, you know exactly what you're going to go up against and how to prepare yourself and get the right documents in place and get all these factors in order so you can have no issues whatsoever. All right, so let's dive into that real quick and take the first thing that we're talking about here, right? It's identity. Identity basically means, well, what do you mean, what is identity? What do you mean? Well, identity is, who are you, right? What's your citizenship status is? Are you legally in this country or not? Do you have a permit, working visa? Are you, allowed to come into the States and buy a property in the United States, right? You have to have legal residence or terms that qualify for legal residence in the United States in order to buy a home in the United States under your name, right? Especially if you're looking for a loan. Obviously, if you're paying cash, it's not required. It doesn't matter. You can buy houses and move forward that way, even though you're not a U.S. Citizen of the States, right? But in essence, identity basically means, who are you? Are you a U.S. citizen? Are you a permanent resident? Are you on a work school visa that you're looking to buy a house because you're going to be here during the school seasons, right? Or during your employment status. There's also what's called deferred action childhood arrivals. That's a DECA scenario, right? Where you have kids that are been in the States since they were babies and grew up here and pay taxes and do everything else, but they were never citizenships of the United States, right? There's also first-time home buyers. Is this going to be a first-time home buy program that you're looking into, or is this you've bought multiple homes in the past and you don't need that, right? You're also whether you're a veteran or not. So identity covers all these 6 factors, and this will determine who you are to the banks and to the lenders in order to determine whether you're lendable to or not, right? Again, that's U.S. citizenship, also permanent resident alien, work school visa, right? DECA. That basically what means deferred action for childhood arrivals, first-time home buyer, or a veteran. So those are the 4 key factors, or 6 key factors, I should say, right, in determining your identity. So this is very crucial for you guys to understand, right? Because without understanding this factor, you're not going to qualify for a refinance or a home purchase, right? Well, actually, in terms of refinance, you've already gotten a loan, so things get easier. But in terms of home purchase, is what you need, okay? All right, so the second factor is your credit. What is it? What's your credit rating? What trade lines do you currently have? Have you had bankruptcies or foreclosures in the past? Do you have a lot of debt in terms of credit card debts? Do you have auto loans? Do you have judgments? Do you have IRS liens? All these factors come into play when applying for a refinance of a home or purchase of a home, right? So credit is a very crucial component of this transaction as well. Just like we said in terms of identity is, so is credit, right? So your credit is broken down to 3 categories, literally. Your credit score is the most important factor in this one. Also take into consideration the public records that I just spoke about, as well as your trade lines and your monthly debits that you have showing on your credit report, right? Anything that doesn't show on your credit report, you don't have to worry about that. But anything that shows up on your credit report is counted against you in terms of debt to income ratios, right? That's why credit is a very, very important factor when applying for a loan, whether to purchase a home or refinance a property. After this credit breakdown, there'll be a simple workbook that I can, click down here to download, whatever the case is, whatever platform you're watching this on there. There should be a link somewhere down below, up or side, whatever the case is, to where you can download this budget and figure out what your monthly liabilities are compared to your income and see what your debt to income ratio is in terms of your credit, which takes into account how much you're spending and how much you have, right? Also to lay out all your liabilities and kind of figure that out, see whether you're going to get in over your head by getting a mortgage loan or not, right? So let's dive into the second or the third category of this one, right? And the third category is your income. what type of income do you currently have, right? Is there multiple sources of income or is it just one? So you got to figure out whether you're on fixed income, right? Meaning whether you're on pension, Social Security, things of that nature, right? Where it does not go up, it just stays flat and it is what it is. Two, whether you have any rental income properties, right? Maybe you're on fixed income as well as rental income properties that you have, and that's how you're able to support yourself and pay off your debts and also provide food on the table for yourself and your family members as well too, right? The other third one is, are you self-employed? In other words, do you have a company of your own that you work? Are you a consultant? Are you a freelancer? Do you have a big corporation or small business? Whatever the case is, are you self-employed? And that typically means that you have income that you generate in order to make money, not working for a company where they pay you monthly or pay you a monthly basis, typically twice a week. When it comes to self-employment, you are in charge of your income depending on how much you make and how much you're spending, right? And the fourth factor is wage earner. If you're a wage earner, basically means you're a W-2 earner, right? If I work for Bank of America, say, and I'm on hourly or salary, that's all I make, and that's all there's to it, right? And I pay my taxes. I have no write-offs and so forth. That's a wage earner. So a wage earner is one that works for a company. Self-employed is one that you control your destiny in terms of what your income is, right? And the second one that we talked about is rental incomes. If you have other rental income or business ventures or whatever the case is that you have income coming in from other places, and like we discussed, the first one was fixed income. Are you on fixed income like Social Security or pension? And therefore, there's no additional income coming from anywhere else. So income is a third key component in unlocking your refinances and unlocking your home purchase loans, okay? All right, and the fourth key to unlocking your mortgage in terms of purchasing or refinancing a home is your debt-to-income ratio. How much do you actually earn and how much are you spending every month determines what your debt-to-income ratio is going to be. To give you, for example, and I'm going to do this for simple mathematics, right? Let's say you earn $10,000 a month. That's what you earn. That's your gross income, whether you're self-employed or whatever the case is. Let's just consider on wage earner right now. Your income is $10,000, but yet you have total expenses of $5,000 total. So what does that make your debt-to-income ratio? Well, you take the $5,000 that you're spending on a monthly basis, divide that into $10,000, and then you have your debt-to-income ratio. In this case, is 50%, right? If you're spending $5,000 of your gross monthly income of $10,000, that means your debt-to-income ratio is 50%. That's how you calculate debt-to-income ratio. Now, when it comes to qualifying for a conventional loan, you're required to have no more than 50% debt-to-income ratio, which includes your mortgage payment, your property taxes, your homeowner's insurance, your car payment, your credit card debts, and anything that shows up on your credit report. You add all that up, the monthly payments, right? And then you add the housing expense, and on the conventional, you cannot surpass more than 50% of the debt-to-income ratio, right? So that's how you determine what the debt-to-income ratio is going to be on your mortgage, whether you're going to qualify for a home purchase or qualify for a refinance. Now, there are other programs out there, right? Like FHA allows you a higher percent debt-to-income ratio, typically 55%. And the VA, if you're a veteran, it allows you up to 60% debt-to-income ratio, right? So keep that in mind when you're out shopping for a home to buy or when you're looking to refinance your house. Know what your debt-to-income ratios are, because that is the fourth key to unlock in order to qualify for either a refinance or a purchase of a home. These are the four important factors like we discussed, right? Number one is your identity, right? You have to, the banks have to know who you are in order to lend to you, and what's your legal status in the United States when you're looking to buy a home in the United States, right? They want to know whether you're, whether you have, whether you're a citizen, whether you're a veteran, whether you're a DECA member, whether you're here on work or school visas, right? They want to know who you are. Any bank, anyone that you're going to go ask for money needs to understand who you are as a person, right, in order for them to lend you money, because they're in the business of getting paid back, right? Two is your credit. You have to have a good credit overall to qualify for a home purchase or refinance. You can't have bankruptcies. You can't have foreclosures. Well, I shouldn't say this. I should say you can't have recent bankruptcies. You can't have recent foreclosures. You can't have recent collections. You can't have recent IRS liens and things of that nature when you're applying for a home to buy or when you're applying to refinance your home, right? All these factors come into play with that. So that's why credit is very, very important. It's not just your FICO score or your credit score that matters. It's all the underlying factors of your credit score that also matter, right? Income is the other factor, and the reason income matters is they want to know, are you going to be consistent with that income, right? Are you going to continue making that money, or or even actually make even more down the line, so that way they know once they lend you the money to buy the house that you have the ability to pay back that loan over time, right? So income is a very, very, very important factor. Obviously, if you're self-employed, or whether you're a wage earner or retired on fixed income, or a combination of things, that's what creates your income. So however your income is, wherever it comes from, you need to calculate that income and to see whether you have the ability to actually pay that monthly payment on your home, as well as pay your other liabilities that you have, like your card payments, credit card bills, and so forth. And that leads me into the fourth key factor, right, which is your debt to income ratio, known as DTI in the mortgage world. DTI is pretty simple, pretty straightforward. Pull your credit report, see everything that your monthly payment obligated to pay on that credit report, and then add your housing expense, and that comes out your total debt to income ratio, and that will determine whether you're going to qualify for a purchase on a home or refinance the current property that you have. Typically, like I said, on a conventional loan, you cannot supersede more than 50% debt to income ratio, right? On an FHA, you can go up to 55%, and on a VA loan, you can go up to 60%. So be very cautious on adding debt when you're looking to buy a house or looking to refinance your property that you currently have. Now, there is one way around that, right? If you have a lot of debt on your credit, let's say you own a house already and you're looking to refinance a house, not buy a house because you've already bought a house. If you're looking to refinance a house and you have a lot of debt that's showing on your credit report, that's okay. Don't panic. Typically, what you can do is what's called a cash out refinance, right? That means you're taking money out of the equity that you have, paying off all those debts to bring your debt to income ratio in line below 50% debt to income ratio on a conventional. So there are ways for you to actually eliminate debt by refinancing, even though you have a lot of debt. As long as you take equity out to pay that debt off, that's calculated to your overall debt to income ratio, and that will then unlock the fourth key to the mortgage, which is your debt to income ratio. So hopefully this makes sense to you guys. Again, thank you for your time. Understand that the four key factors in unlocking any refinance that you're looking to do on a home mortgage or looking to buy a property when it comes to whether you're personal property or rental properties, right? That's your identity, who you are. 2 is credit. What's your credit like? 3 is your income. And 4th is your debt to income ratio. Thank you, everybody. Hopefully that helps you guys out tremendously. Take care. Thank you.